Hold on, if you're over 65, what I'm about to reveal could save you from losing up to £10,000. HMRC has announced major changes coming in 2026 that could catch millions of pensioners completely off guard. In the next few minutes, I'm going to show you exactly what's changing, who's at risk, and most importantly, the simple steps you need to take right now to protect your hard-earned money. Don't click away because by the end of this video, you'll know exactly how to safeguard your finances from these upcoming changes. Welcome back to UK State Pension with David. I'm David, and if you're new here, it's absolutely wonderful to have you join our community. On this channel, we break down everything you need to know about the UK state pension, tax changes, benefits, and financial matters that directly affect pensioners across the United Kingdom. Today's topic is critically important because we're going to discuss the HMRC changes coming in 2026 that could seriously impact your finances if you're not prepared. These changes affect millions of people over 65, and I want to make sure you're fully informed and ready. So get comfortable, grab a cup of tea if you'd like, and please don't forget to subscribe to UK State Pension with David and hit that notification bell so you never miss crucial updates like this one. A quick click on the subscribe button helps us reach more people who need this vital information. Let's dive straight into what's happening with HMRC in 2026 and why this matters so much to you. The tax authority has announced several significant changes to how pensions and retirement income will be taxed and managed. These aren't minor tweaks to the system. These are substantial changes that could have a major impact on your disposable income, your savings, and your overall financial security in retirement. The most alarming part is that many pensioners have no idea these changes are coming, which means they're not taking the necessary steps to protect themselves. First and foremost, we need to talk about changes to the personal allowance and how it interacts with pension income. Currently, everyone in the UK gets a personal allowance, which is the amount of income you can earn before paying tax. For most people, this sits at £12,570. However, HMRC has frozen this allowance until 2028, which means it's not rising with inflation. But here's where it gets particularly challenging for those over 65. With state pensions increasing each year due to the triple lock and many people also receiving private pensions or workplace pensions, more and more pensioners are being dragged into paying income tax for the first time, or paying significantly more tax than they did before. Let me explain this with a real example so you can understand exactly what I mean. Imagine you're receiving the full new state pension, which is currently around £11,500 per year. Add to that a modest private pension of just £3,000 annually. That puts your total income at £14,500. Suddenly, you're £2,000 over the personal allowance threshold. That means you'll be paying 20% tax on that excess, which works out to £400 per year. Now, multiply that over several years and you can see how quickly it adds up. But it gets worse. If your income is higher, perhaps you have a more generous workplace pension or some rental income, you could find yourself losing even more. Now, here's something that catches many people completely by surprise. There's something called the age-related allowance that used to exist in the UK tax system. This gave pensioners a higher personal allowance than younger workers. However, this was abolished back in 2016 for anyone born after April 1938. If you were already receiving it, you were protected, but no new pensioners could claim it. Fast forward to 2026, and with the personal allowance frozen and pensions rising, the gap between what you receive and what you get to keep is widening significantly. This is particularly painful for those who worked hard all their lives, paid their national insurance contributions, and expected a comfortable retirement. Another crucial change coming in 2026 relates to how pension withdrawals are taxed. If you have a defined contribution pension, commonly known as a private pension pot, the rules around accessing this money are changing. Currently, you can take 25% of your pension pot as a tax-free lump sum. This has been an incredibly valuable benefit for millions of pensioners, allowing them to access a chunk of their retirement savings without paying a penny in tax. They use this money for home improvements, paying off debts, helping family members, or simply having a financial cushion. However, there are proposals being discussed that could limit this benefit or change how it's calculated. While nothing is set in stone yet, the direction of travel is concerning. HMRC is looking at ways to increase tax revenue, and pensions represent a significant pool of money that could be targeted. Let's talk about another area where pensioners could lose substantial amounts if they're not careful. This concerns inheritance tax and pension pots. Under current rules, if you die before age 75, your pension pot can usually be passed on to your beneficiaries tax-free. If you die after 75, they'll pay income tax on withdrawals at their marginal rate. However, there are discussions within government circles about bringing pension pots into the inheritance tax net. Currently, pensions sit outside your estate for inheritance tax purposes, which makes them an incredibly efficient way to pass wealth to the next generation. If this changes in 2026 or beyond, people who haven't planned properly could see their families hit with massive tax bills. We're talking potentially thousands or even tens of thousands of pounds that would go to HMRC instead of your loved ones. State pension credit is another area where changes are causing concern for those over 65. This is a benefit designed to top up your income if you're living on a low income in retirement. However, the eligibility criteria and how it interacts with other income sources is becoming increasingly complex. Small changes to how your savings or pension income is assessed could mean the difference between receiving this vital support or losing it entirely. For someone on the borderline, losing pension credit doesn't just mean losing the weekly payment. It also means losing access to other benefits like help with housing costs, council tax reduction, free TV license for over 75s, and help with heating bills. The cumulative loss could easily exceed £10,000 over a few years. Something else that's particularly important to understand is how HMRC's increased use of technology and data sharing is affecting pensioners. The tax authority now has sophisticated systems that can track income from multiple sources automatically. This means if you have state pension, a private pension, some savings income, perhaps a bit of rental income, HMRC can see all of this in real time. While this might sound convenient, it also means mistakes can happen more easily, and you could find yourself being taxed incorrectly without realizing it. Many pensioners who aren't used to dealing with complex tax affairs find themselves overwhelmed by tax codes, unexpected bills, and demands for payment. If you don't check your tax code regularly and understand what you should be paying, you could end up paying hundreds or thousands of pounds more than necessary. Let me share with you some absolutely essential steps you need to take right now to protect yourself from these HMRC changes. First and foremost, you must understand your total income picture. Sit down with all your pension statements, any savings account statements showing interest earned, rental income if you have property, and any other sources of income. Add it all up and compare it to the current personal allowance. This will tell you whether you're likely to be paying tax and how much. If you're close to the threshold, even small increases in your state pension due to the triple lock could push you into a higher tax bracket. Second, check your tax code urgently. Your tax code determines how much tax is taken from your pension before you receive it. If this is wrong, you could be paying too much or too little tax. If you're paying too little, HMRC will eventually catch up with you and demand the money back, often in a lump sum that causes financial distress. You can find your tax code on your pension statements or by logging into your personal tax account on the HMRC website. If you're not sure whether it's correct, contact HMRC or speak to a tax advisor. Third, consider your pension withdrawal strategy very carefully. If you have a private pension pot, don't just withdraw money without thinking about the tax implications. Taking too much in one tax year could push you into a higher tax bracket and cost you thousands in unnecessary tax. Instead, plan your withdrawals strategically. Perhaps spread them over multiple tax years, or coordinate them with other income sources to minimize your total tax bill. This is where professional financial advice can be invaluable. Fourth, make sure you're claiming everything you're entitled to. Many pensioners miss out on benefits and support simply because they don't know they exist or they think the application process is too complicated. Pension credit, housing benefit, council tax reduction, attendance allowance, if you need help with daily activities, these can all add up to significant amounts of money. There are free services that can help you check your entitlement, so please don't leave money on the table. Fifth, keep excellent records of everything. In this new digital age where HMRC tracks everything automatically, you need to be able to prove your income, your expenses if you have any, and your tax payments. Keep copies of all pension statements, P60 forms, tax code notices, and any correspondence with HMRC. If there's ever a dispute, having documentation makes resolving it much easier. Sixth, consider getting professional advice if your situation is at all complex. A good financial advisor or tax specialist who understands pension taxation can save you far more than they cost. They can help you plan your pension withdrawals, understand your tax position, claim reliefs you might not know about, and structure your finances in the most tax-efficient way possible. For many people, especially those with multiple income sources or significant pension pots, professional advice is worth its weight in gold. Now let me address something that worries a lot of people. What if you've already made mistakes? What if you've been paying the wrong amount of tax for years and only just realized it? Don't panic. HMRC does allow you to go back and claim refunds for overpaid tax, usually for up to 4 tax years. If you think you've been paying too much, you can contact HMRC and ask them to review your position. Thousands of pounds of overpaid tax are refunded to pensioners every year, so it's definitely worth checking. It's also worth mentioning that these HMRC changes don't affect everyone equally. If you're fortunate enough to have a generous final salary pension or significant savings, you need to be even more vigilant because you have more to lose. On the other hand, if you're living on just the state pension with little other income, some of these changes might not affect you directly, though you should still stay informed because the rules can change. One final point I want to stress is the importance of staying informed and engaged with these issues. The pension and tax landscape is constantly evolving. What's true today might change tomorrow. By staying connected with reliable sources of information like this channel, UK State Pension with David, you give yourself the best chance of adapting to changes and protecting your financial interests. Don't rely on rumors or secondhand information. Get your facts from official sources or trusted experts. We've covered an enormous amount of ground in this video, and I really hope it's given you a clear understanding of what's coming in 2026 and what you need to do about it. The bottom line is this: the combination of frozen tax allowances, rising pensions, and various rule changes means that many people over 65 could find themselves significantly worse off if they don't take action now. That potential loss of £10,000 I mentioned at the start? For some people, it could be even more than that over several years. But the good news is that with proper planning, understanding, and action, you can protect yourself. We're coming to the end of this important video, and I want to thank you so much for watching all the way through. Your time is valuable, and I'm grateful you've spent it here learning about these crucial changes. If you found this information helpful and you think it could benefit other pensioners, please share this video with them. Send it to friends, family members, people in your community who might be affected. Knowledge is power, and the more people who understand these changes, the better prepared we all are. If this video has been useful to you, I'd really appreciate it if you could click the thumbs up button below. It helps the YouTube algorithm show this content to more people who need it, and it lets me know that you value this kind of detailed, practical information. And if you haven't already subscribed to UK State Pension with David, please do so now by clicking that red subscribe button. Make sure to hit the notification bell as well so you're alerted whenever I publish new videos about pensions, benefits, tax changes, and other financial matters affecting pensioners. I read every single comment on my videos, so if you have questions, experiences to share, or topics you'd like me to cover in future videos, please leave a comment below. Your feedback helps me create content that truly serves your needs. Whether you want to know more about specific benefits, need clarification on tax matters, or have concerns about upcoming changes, let me know and I'll do my best to address them in future content. In upcoming videos, I'll continue to keep you updated on all developments related to state pensions, HMRC changes, benefits, and everything else that affects your financial well-being in retirement. This is such a fast-moving area, and I'm committed to being your trusted source of clear, accurate, and actionable information. So stay subscribed, stay informed, and most importantly, take action on what you've learned today. Thank you once again for watching UK State Pension with David. I'm David, and I'm here to help you navigate the complex world of pensions and retirement finances. Take care of yourself, take care of your finances, and I'll see you in the next video very soon. Thanks for watching, and goodbye for now.